Hey everyone, this is Kirk here again at optionalpha.com and welcome back. This is the video recap for May 21st, Wednesday, and today I want to go over both the one opening trade that we had for today, Wednesday, and that's USO, and then also cover our CAT calendar that we opened up on Tuesday. So Monday was very active and we had lots of trades on Monday, but then Tuesday and Wednesday this week just didn't get a lot filled, and the market, although has been pretty active, just not a lot of orders in the option side filling. So kind of combining these into one quick video here. So first, let's go over that CAT calendar that we traded. And again, we've been trading a lot of these calendars lately because implied volatility is low, right? And this is one of those strategies that you can use right inside the membership area on our website at optionalpha.com. And you can see that one of the great strategies to use during low implied volatility times is not only debit vertical spreads, but also calendars. And the way that we like to trade calendars is we like to trade them a little bit out of the money, and we do trade them on both the call and the put side. So we have a call calendar going on Facebook right now that we entered a couple days ago. And now we're entering a put calendar, or entered yesterday on Tuesday, a put calendar in CAT. Now, I know this trade kind of slipped up a couple people out there because the 100 that's here usually designates on every single one of the trading alerts that we have because each contract controls 100 shares of stock. But this is actually the 100 strike put options that we were trading, and that's why I kind of added and really customized this alert that went out to our members just to make sure everyone was clear that, yes, these are the 100 strike options that we're trading, and I know we don't trade the 100 strikes that often in a lot of things, so it did kind of confuse a couple people out there. But again, just to recap, what we're doing with this calendar spread is we're going ahead and we're buying the July 100 strike put. So we're buying the back month options for July, and we're selling the front month options, which are June expiration. So buying longer term options, so we're longer term options, and we are short the front month or June options with about 30 days to go till expiration. Now, the benefit in doing this is that, or the idea behind doing this is that we want to see not only a move in the stock down to our strike price, that would be ideal, but we also want to see implied volatility go up. And the reason that we want to see this is because implied volatility will benefit our long June contract more than it will hurt us being short it'll benefit the long July contract more than it will hurt being short the June contract for the 100 strikes. So that's what we're really playing. We're really playing time against itself and hoping for a little bit of a directional move in the stock, but also possibly a move up in implied volatility. Now, if we actually go to the chart here of CAT, you can see that we had a really lucky day, and Caterpillar, which is actually been one of the more quiet stocks in the Dow and in the S&P that has just been slowly moving along, actually had a monster down day on Tuesday when we sold this. And this is right before we actually sold this option or this calendar or bought this calendar spread. So we actually had great timing in this, and it's nothing more than dumb luck. It wasn't some technical indicator that we looked at. It was just really good luck in entering a trade and then having the market move almost exactly where it needed to move yesterday. So had a really good move in Caterpillar moving down. Now again, our focus is on the 100 strikes. So we kind of want Caterpillar to settle somewhere around 100 by June expiration, which is this red dotted line here on our charts. And if we can get Caterpillar to do that, that would give us the biggest potential for profit. So even right now, as it kind of bounces back up, you can see that it's clearly broken a very long-term trend that it has moving higher. So I think that even though it could rally and move back up, that we have an opportunity here to see Caterpillar come back down and kind of settle into this range further on in the expiration cycle, which would just only increase our potential for profit. If we go to the Analyze tab, just so you guys can see what this looks like on Caterpillar, what our actual spread looks like. It looks a little something like this. This is your pretty typical calendar spread where you have this kind of huge peak right around that strike price that you sold and bought for the different contract months. So we have that right around our 100 strike. Now right now, Caterpillar down at 102.84 is just on the fringes of being profitable at expiration. We're still up on the trade right now, but again, we'd like to see the stock move just a little bit more down into the 100 range before we actually start taking profits. But our big profit range is really anywhere between 97 and basically where it's at right now at 103. So we're giving ourselves a pretty good range to make money between 97 and 103. If we go back to the chart, you can see that 97 is all the way down here, and 103 is just about where it's at right now. So we have a good range, and so even if Caterpillar crashes here, we don't exactly need it to stop at 100, but inside this range is really kind of the money zone for these calendars is really inside that range. So good trade, really like the trade, and it's already starting to work for us, which really helps out. Now today, Wednesday, we went ahead and bought some long exposure into USO. Now we're currently short some XLE in the Spider ETF for energy, so we do have some short exposure to energy, but given the breakout in USO, this new trade, we want to treat it as such that we want to treat it as a new trade for July and getting some long exposure to oil going forward. So we went ahead and bought a very simple debit spread in oil. It's a $2 wide debit spread, so we went ahead and bought the 37 options, sold the 39 calls against those to help kind of finance that purchase. But even after that's said and done, we still paid a debit or paid out of pocket about 102. So a little over mid price in what we like to pay. We like to pay around $1 for these. Can't always get that exact same price. So, but what that does is move our break-even point to about 38. So that's ideally where we want the stock to trade. Anywhere above by July expiration, or between now and July expiration, is above 38. So if we go to USO, we had a nice up move in USO today. It's kind of rallying and breaking out of this area that it's had before. You can notice that it's kind of hit its head and really met a lot of resistance until now, coming up to and right near this 38 level before in the past. So it's kind of rallied to here and hasn't really broken out until today. It kind of popped its head above that level. So if we take this as a breakout sign, and again, it's just making a directional call in the market, then we obviously want USO to continue trading higher between now and July expiration. So we have given ourselves quite a lot of time between now and July expiration to be right. So we can hold on to this thing for quite a long time through the rest of the summer, basically, or at least into the summer months when oil starts to really pick back up, the driving season, etc. People start traveling. That's the idea with this trade, is to get some long exposure in case the market does rally here as we get into the summer. So that's really it. There's only 2 trades today, 2 quick trades, but I just want to go over those in a little bit more detail. As always, if you guys have any comments or questions, we'd love to hear them right below this video, and we'll get back to all of those tonight or tomorrow before the open. Happy trading.